Chapter 5 of payroll, we talk about unemployment compensation taxes, both the federal and the state. So those are abbreviated FUTA and SUTA. So it stands for the Federal Unemployment Tax Act and then the State Unemployment Tax Act. So basically the federal, when companies, so both these taxes are paid by the employer only. So the employee never sees this tax come out of their paycheck and they're not responsible for it. It's only for the employer. So, so basically it says that the employers are liable to pay tax if they pay wages of more than $1,500 in a quarter, or they employ one or more person for 20 calendar weeks. So then in that case, they're required to pay into the federal unemployment tax system. Now that when they pay into the federal unemployment tax system, it just supports the system. It's a smaller percentage. The state is going to be the larger percent, and that is actually where the unemployment gets paid out of. So the employee that would get laid off is going to file with the state, and that's who pays them. So that's why that expense or that percentage of the expense is going to be much higher. And then every state is kind of set up a little bit different from an unemployment tax standpoint. But what they cover is going to be, obviously, if the employer loses their, if the employee loses their job without quitting, but if they're fired or they're laid off, so the rules here would say that the employees have to be, these are what we have listed here, this ABC test, these are the ones who can be excluded. So basically any employee that works for the company as an employee is going to be covered. So then this list says these are the people who would not be. So if they're free from control or direction, so that would again be more like an independent contractor. If their work is performed outside of the usual course of business. So like, let's say you're an accountant and you do the books for a restaurant. Well, you may come in on a Sunday and pick up those books to do them, or maybe even sit at a booth after hours and get that work done. So it's going to be work performed outside of the usual course of business. Again, you're not, if you're in that restaurant, you're not a cook or a waitress, you're just coming in to do the books. And then again, if they're customarily engaged as an independent trade or a business. So again, those would be independent contractors. And a lot of times how the IRS looks at the independent contractor is, are they marketing themselves to other businesses? So do they have more than one customer? That would normally indicate that they are self-employed and that they are an independent contractor, in which case those people you do not pay, as the employer, you do not pay unemployment tax on. Then the next bullet point talks about, well, what if the employee works between multiple states? So say you've got a salesperson who travels in a tri-state area. Are they going to have to pay unemployment tax to each one of those states? So no, what they're going to do is, to not duplicate that contribution by the same company, they're going to pay in any one of these four down below. So either where the work is localized, so maybe their home office is in Ohio, but they travel over to Pennsylvania and West Virginia, but the majority of their time is spent in Ohio, and that would be the location of their base operations also. If the location of the place where the operations are directed or controlled is different than that base operations, but that's where they report to. So like, for instance, at the oil and gas company I worked for, our actual corporate headquarters were in Texas, but we had offices in Pittsburgh and in Hartville. So if we worked in Pittsburgh, obviously you would be paying the Pennsylvania state unemployment taxes. Working in Ohio, we paid into the Ohio state, and our workers down in Texas, we also had a branch in Oklahoma. So I mean, each different branch was there. So it wasn't necessarily our headquarters, but it was where that office and where those people were worked. And then that would probably normally also tie to the employee's residence as well. But I guess if you live right on a state line, that could vary. So then you're going to go back to where that work is going to be localized. So what type of wages do we pay federal unemployment tax on? FUTA covers the first $7,000 of wages paid in any calendar year. And that's going to include their salaries, their wages, bonuses, commissions, tips, if there's any retroactive wages, if there's any stock bonuses that are paid, any of those kind of things that calculate into the wage base is going to be paid. Down below, there's some exempt things, like if you get reimbursed for business travel or business expenses, payments that go into your retirement plan, if they pay for your tuition reimbursement or educational assistance, if they provide meals and lodging for their benefit, so not for yours, but for theirs. So maybe they're sending you to go to 4 days of training and they're going to provide lunch all of those days. Obviously, that's not going to be a taxable benefit to you, or strike benefit payments are also not taxable. So then what type of credits go against the federal unemployment tax? Because it really ends up just being 0.6% that employers will pay, that's where this 0.54 credit comes in. The employer must have made contributions into a state unemployment fund in order to qualify for that 5.4% credit. If it's not made, say they owed at the end of the quarter and they didn't pay, and they may get fined by the state, but they're also not going to get the full credit. They'll only get 90% of that credit, which means they're going to be paying like a 10% penalty if they are not paying the state timely. Even if they pay multiple states, they still just get that 5.4. So what you kind of get used to when you're doing payroll taxes is that what goes to the FUTA is 0.6%, assuming the company's paid into the state, which in almost all of our examples, that's the case. Okay. So then the SUTA laws. So basically all states have these pooled funds where that's where they're going to be paying the employees that get laid off or lose their jobs out of. And it's going to be spread among all the employers. So when a brand new employer comes in and files to get an unemployment account, they're going to just have this initial contribution rate because they don't know anything about this employer yet. So it'll take time to get that experience rating. Once the employer's been up and running for a while, then what determines their rate is this experience rating. So if they have low turnover, they'll pay a low unemployment tax rate. If they are laying off workers on a regular basis, they're going to pay a higher rate. So what is commonly used is this reserve ratio formula. And it's basically, it looks at how much reserve they have, and then you tie that over to a specific rate based on if they've got 10% left in their reserve account. So if they're a positive balance, anything above zero, they're going to have a lower tax rate. And there's a table in the book that you can look at that to see what those rates are. A negative balance says, okay, they've actually paid out more than they've contributed into the plan. So obviously they're going to be paying for that. So what they'll normally do is if your account goes negative, you will get a statement at the end of the year that says, would you like to make a one-time payment that brings your balance up to zero, and then you have a lower rate? You can choose not to, but then you're going to pay at that higher rate. Again, we'll have a problem that you can see the mathematics of it. Normally it works out to save money to go ahead and get it up to the zero and then pay that lower percentage rate. And then deposits into the federal unemployment system are quarterly. So if it's over $500, that's when you'd have to deposit quarterly. If it never gets up to $500, if it's $500 or less, they can wait, and then if it's 500 less for the entire year, they don't have to wait. They can wait all the way until they file their Form 940 at the end of the year. There's an example of that 940 in the textbook, and then they could just enclose their payment with that. The companies that I have worked for have always paid electronically. Even the small business that I do some accounting services for, we go online to the EFTPS site and pay at the end of the first quarter, because normally for it's very small business, but they're normally, that's all they owe is that first quarter, and then they're over that $7,000. So that's how I normally have done it, and not waited till the end of the year, but you could, and then just pay that payment with the Form 940. So then this kind of gives you the different parts of the Form 940. Again, I recommend going to the textbook and looking at that example that's in there, figure 5.2, so you can kind of see what's in it. But it's due by January 31st of the next year, so it'll cover that whole year. And it has multiple sections. So you've got your part 1 information about what state are you paying into your state unemployment. Then you'll calculate that federal unemployment tax, determine if there's any adjustments. So the things that will come out of that is, did the people contribute into a 401k plan or a cafeteria plan, things that are pre-tax, you would deduct those out. Any wages over the $7,000, you'll deduct those out. Then it'll show you, okay, this is your wages that are subject to federal unemployment tax. Multiply that by the 0.6%, and then you'll get to your FUTA tax amount. Then you'll compare that to the deposits that you've made, and then hopefully if you're a quarterly payer, it all just zeroes out. So you know your liability, you paid in your deposits, you owe nothing. If again you're under that $500 for the whole year, then you would show what FUTA liability you have, and then you would pay that, and it would be signed by the owner, the payroll manager, the CPA, whatever agent is handling that for the company. You can do an amended one, and you just check that box. And then again, you can also file electronically. And like I said, the companies that I've worked for, we've done that, and we've paid electronically as well. Then the state unemployment tax reports are all going to be different depending on what state you're in. So it's a good idea to go online and look up what the Ohio state unemployment tax form looks like. But what it does is it makes you list all your employees with their social security number, their name, how much do they make in that quarter, and how many weeks were in that quarter. And then so you may have multiple pages of that if you have many employees, or maybe just one if you have a handful of employees. It's a small business. Then you'll come down to like the reconciliation point where it's going to say, okay, what is my total unemployment? What are my total wages subject to unemployment? And then you multiply that by your unemployment rate. And again, it too, though, is based on the limit. So, if it's up to $8,000 or $7,000 is all you're going to pay taxes on. So whatever that limit is for the state, you would only pay up to that point. Then anything over that limit, the $7,000 or $8,000, is not going to have any state unemployment tax paid by the employer. So then that kind of shows again what you owe, and then it'll say how much payments did you make. And then what the state of Ohio does is you just pay every quarter. So you fill out all that information, what's taxable to you this quarter, and then you submit your payment with that. So there isn't necessarily a year-end filing as much as in the state of Ohio. It's just a quarterly filing that then you pay as you go. Okay, so that is our federal and state unemployment tax.